Okay, I think it should be going. All right, what's up, everybody? This is Danny and Chen. We're the creators of ghostquawk. So what we wanted to do today is give you an overview of our product, the services that we offer, and how you can use it in your trading. Okay, so the first, just take a little bit of time to talk about where we started, our origins. This initially started as a service that we built in-house to use it ourselves, right? We wanted to basically make a tool that would help us in our trading, all right? And it basically just ran as a program on the desktop, which kind of got to be cumbersome if you wanted to go trade with a buddy or trade at a house or on a computer that wasn't yours. So basically, this just evolved into a website. So what is ghostquawk? Primarily, it's a news aggregation service. So basically, we scrape we scrape for news from all over the internet because basically the existing services that are around span from anywhere from $150 a month to $3,000 a month in the case of Bloomberg. And a lot of new retail traders just don't have that, right? And we didn't at the time, so we created this just to help ourselves trade. There is an audio squawk component, so when news comes out, the platform will read it to you. We also have a proprietary risk on and risk off sentiment indicator, which is what we're going to be talking about. We'll give some examples of how that works, toward the end of this module. We also have proprietary technical trading indicators, which are very, very useful, especially if you're more of a technical trader. And of course, we offer educational content. So if you want more information on this, just by all means, pop on over to ghostquawk.com and check out more about what we offer. So this is the news. So Chen is very, very experienced in the area of news trading. So he's going to go ahead and tell you a little bit more about what we offer here.
Yeah, so the idea of ghostquawk is to scrape the internet for breaking headlines and news, and using these breaking headlines and news to help you take positions in the markets. So what ghostquawk does is that it scrapes the internet for various resources, news resources on the internet, such as certain websites, RSS feeds, Twitter, and things like that. And it runs it through a proprietary algorithm, which then feeds into our risk on, risk off sentiment analysis. And using that particular tool, you should be able to help you make good trading decisions on whether or not you want to be positioning long or short in particular markets based on the sentiment of the day. So what is risk sentiment and why should I care? So first and foremost, risk on, risk off sentiment is a complex subject, and we will have another video diving into this form of analysis. But for most part, for investors and traders, the appetite for risk essentially drives trading and investing strategies. So there are essentially three modes when it comes to analyzing risk on, risk off sentiment. First off, there's risk on, then there's risk off, and then there's a neutral state within the markets. Now, based upon where we are with regards to risk sentiment, you should be able to position yourself trading the stock market, whether you want to be long or short. You can do the same thing in the bond market, the forex market, or the commodities market, having a solid understanding of analyzing risk within the markets. So the risk sentiment indicator itself essentially gives you a very good background understanding on how you want to be positioned. Different securities will obviously react differently depending upon the environment that you are operating in. So for example, when we are on a risk on market, the riskiest asset class to be a part of in the market would be the stock market. So when we get risk on sentiment in the markets, you typically want to be positioning yourself going long in the stock market. So you can take particular stocks like Apple, Google, Amazon, and go long based upon risk on, or you can approach trading the indexes by positioning yourselves going long because the risk on sentiment is being shown in the markets. Other assets, when stocks are rallying, will typically sell off. So this would include markets such as like the bond market, gold, or the Japanese yen would typically sell off when you are in a risk-on environment in the markets. So that's a very unique way of analyzing risk on, risk off sentiment in a very short summary. It's a very complex type of analysis, but what we have done with ghostquawk is essentially develop proprietary indicators to help break down the risk on, risk off sentiment within the markets by showing you guys an indicator and using this indicator to help you position yourselves to trade the markets.
Awesome. So we're going to be, the nature of risk on and risk off, what that means is a very, very complex topic. And we discuss about it a lot in our course, that we offer through ghostquawk. So if you're interested in learning more, by all means, check us out at ghostquawk.com and you maybe sign up for one of our courses. But to give you a little bit more information on the risk sentiment tool, just to take a step back for a second, my background is machine learning, mathematics. I got my degrees in math and physics, and have pursued a lot of machine learning and artificial intelligence, specifically for the financial domain, right? So this risk sentiment indicator is a proprietary machine learning algorithm that I made myself. It's been trained off of thousands of real life examples. Chen and I have been studying, risk on and risk off behavior and what constitutes that for many, many years. So what we did is we just came up with a corpus of thousands of training examples, and I created a natural language processing algorithm that was trained off of those examples that we hand selected. So what it does is it reads the headline and it evaluates this for risk on, risk off, or neutral sentiment, and it does that in real time. So for the duration of this presentation, we're just going to go over some actual real life examples that we used in our own trading based off of this system. The first one was actually yesterday. That was the 16th. And what we'll see is a snapshot of the risk sentiment when the futures market closed. Okay, all these examples that we're showing you are concerned futures, right? And we've pretty much boiled it down to primarily be what we focus on most, which is the bond market and stocks. In particular, we're looking at the futures contract that tracks the S&P 500. Okay, that's ES. So if you see that symbol in the slides, you know what it means. And also ZB is the futures contract that tracks the 30-year U.S. Treasury bond. Okay. So what we see in the beginning is that risk sentiment is heavily green, and I've used that as a color indicator to tell us when things are risk on. So at open, we see that the ES, or again, that's the futures contract that tracks the S&P 500, is going to rally, and the ZB is going to fall. Because remember, as Chen discussed a few slides back, the ZB, or the risk off products like bonds, gold, or the Japanese yen, are inversely correlated to stocks, right? Because stocks are risk hungry products. Okay, so this is what ghostquawk looks like. You see basically this little panel of the headlines that will be constantly repopulated as they come out. And in the top left corner, we see the risk on how. This is basically telling you how many articles were risk on, how many were risk off, and how many were neutral. And what you want to look for is not just whether this text here is green or yellow or red, red being risk off and yellow being neutral, but it's by how much. Okay, so here we see that the risk on headlines are almost double that of the risk off. So this is saying that the news is pretty much decidedly risk on this morning. And as we can see, in this snapshot of what happened at open, we see this big rally in the stock market. Now, what does that mean for bonds? Well, remember we discussed that the bond market typically moves inversely correlated to the stock market, and as you can see here, we have this gap down here in the bond market. So next example, I want to talk about some of the finer nuances of trading, and that's how to deal with low liquidity. Okay, the following example illustrates two principles actually, one of which is low liquidity and one of which is a balance in the risk metric. So we just gave an example of what you do if the sentiment is slighted to one way or the other, but what about when it's roughly even? Okay, so we're going to talk about that in this example. But first, I just used the term low liquidity. What exactly does that mean? Well, liquidity in general is a pretty complex, in-depth topic. So again, if you want to learn more about that, you might want to check out our educational videos. But just for the purposes of this lecture, basically low liquidity means that not much trading is happening. And this happens in between market hours. Of course, there's a lot of other reasons why this might happen, but in general, it may happen because just in between the hours of operation in major markets. By major markets, I'm talking about the U.S., obviously North American in particular, or in general, the Asian markets, and of course the European. So also risk metrics. What I mean by roughly balanced is that the number of articles in the risk on direction and the number of articles in the risk off direction are roughly the same. Okay, we don't see an overwhelming preponderance in one direction or the other. And what that means is that the market is giving you indecision or ambivalence. Okay, there's either a lot of pressure in both directions, the risk on and the risk off side, or the market's just not really caring very much. But both of regardless, both of these factors tell us that it's probably a good idea to stay out of a trade. So for this example, we see risk on 7 and risk off 6. That's only a difference of 1, and that's really not enough. Even though, yes, okay, there's more risk on than risk off, it's still not enough to tip the scales, in my opinion, to tell us that the market is risk on. This is more of an indecisive environment or an ambivalent environment. And what we see, and the second factor being that this is in low liquidity hours. So again, we're looking at the ZB here. This is the bond futures contract, which is pretty much just hanging out. It's just kind of drifting. You tend to expect to see that during low liquidity hours, right? The markets just kind of drift. If they do go, one way or the other, there's no momentum to it, not a lot of buying and selling pressure. It's just kind of hanging out. And again, we see the same for stocks. Okay, there's maybe 4 or 5 tick range here. It's just kind of drifting, hanging out. And again, that's due to low liquidity and really not a lot of interest in the markets right now. Okay, so next we're going to talk about, this is another example, and this is what I call risk sentiment divergence. This example was actually taken today on the 17th. It was particularly this was, the first snapshot was taken before market opened. But what do I mean by divergence, right? This is the lag between the indicator and market action. This is not just, divergence is not just unique to the risk sentiment indicator. It could be any indicator. It could be any technical indicator. If you see your technical indicator telling you something, but the market hasn't responded, that's what we call a divergence. And in this particular example, we saw a decisive risk on sentiment valuation, but it was during the hours before open. The hours before the North American Open. In particular, it was at 7:40 a.m., so that's roughly 2 hours. So we had plenty of time for the market to price in this data. So again, we're seeing low liquidity during this time. Again, to bring this back to the fact that in between the major market hours of operation, you tend to see very little action, right? Low liquidity. So as we discussed before in the previous slide, you want to avoid trading at this time. And you also may anticipate the markets to catch up at open. So again, going back to our risk sentiment indicator, the risk on articles outnumber the risk off by about 3 to 1. So the market, again, is very, very decisively risk on. But as we see here in stocks are just kind of hanging out. However, more toward market open, we do see a little bit of a rally. Um, this isn't an incredibly good example, but it's still an example of how the markets can price in this data. We see a better example with bonds. Okay, I have this level drawn here. This level is months old, and bonds, tend to be very good technically at respecting levels. So we see the ZB come and just kind of drifting, hanging out, and it touches that level. And then later on toward market open, we see this dramatic drop in the bond market again. We remember that risk on and risk off affect products very differently. In a risk on environment, as we saw in this example, stocks rallied, but bonds vary inversely with stocks, right? So what makes stocks rally is going to make bonds sell off, and that's exactly what we see here.
So later in the afternoon, you can see that the risk sentiment is still very risk on. And you want to take note at how some products across different asset classes react to this type of sentiment. So we can see here on the risk on, risk off indicator, we're sitting at 21 to risk on, 11 to risk off, and 17 to neutral. And in that situation, we can see how certain markets react, specifically looking at cross-asset correlations between the S&P 500 index, the 10-year U.S. Treasury note, the USD JPY forex pairing, as well as gold. So as we can see here in a very strong risk on sentiment, the top left chart is the S&P 500, and on a risk on sentiment, you see how the market tends to push towards new highs of the day. Whereas if you look at the bottom left chart, the dollar franc tends to have a similar relationship to that, in the sense that the US dollar typically rallies against safe haven currencies like the Swiss franc or even the Japanese yen. So you typically have a positive correlation between the S&P 500 index and safe haven currencies like dollar yen or dollar franc in this example on a risk on sentiment indicator in the markets. On the right side, you can see the top right chart, the 10-year US Treasury note, and the bottom right chart, the price for gold in the markets. As you can see in the risk on markets, these products will typically see a lot of selling pressure. And as we can see here, the ghostquawk risk on, risk off indicator shows very good examples of cross-asset correlations in the markets, as well as how they affect and correlate with one another as the day progresses. So risk sentiment does shift throughout the day, and that's one thing to note about ghostquawk's indicators itself, is that as new information and headline is constantly being fed to the algorithm, the indicators itself will change throughout the day. So let's take a look at another example of how these same asset classes reacted later on during the day. So as we can see here, risk on has now dropped to 8 and risk off has jumped to 22, where neutral is sitting at 19. So the algorithm reads all of these indicators and is giving us a very strong sense of how the market has shifted from risk on to risk off in a period of several hours. As we can see here, note the products on the left. As you can see, the 10-year US Treasury note and the gold market is rallying in a risk off environment. So the market is taking off risk, and you can see the products essentially rallying in that sense. If we take a look on the left side with regards to the S&P 500 index on the top and the USD JPY on the bottom, there's a slight bit of divergence there, in the sense that the stock market is not really selling off that much in the midst of a risk off scenario. And that type of divergence does typically happen in the markets as we get later on during the day, as liquidity begins to dry up in the markets. The divergences tends to be more pronounced. So in conclusion, just to wrap things up for myself and for Danny, ghostquawk is a service that we've created ourselves to allow us to get a much stronger edge in trading. By essentially understanding how to read impactful news that breaks in the market and using that information to help us decipher risk on, risk off within the markets, we essentially gain a much stronger edge. And that's what ghostquawk is all about. It's all about giving traders that additional edge that they need in the markets to be consistent with, or sorry, to be confident with their trading, and then ultimately to be consistent within their positions in the markets. So we help traders by giving them various tools, such as the proprietary indicators, the risk on, risk off sentiment indicators, our news aggregator, as well as the squawks itself, and our robust educational services. These are all things that are available on our website. If you guys would like more information, you can find us at ghostsquawk.com. If you want to reach out to us, you can always connect with us on social media. You can connect with us on Discord. A link to the Discord will be dropped on the description of this video, so you guys can access that and join our free Discord channel to reach out to us. We have a free trading community there where we provide a lot of more information to essentially foster a community of traders and help out. With that being said, we'd like to thank everybody for joining the video, and happy trading.
Yeah, thanks for tuning in, guys. Stay tuned to our channel. You can either subscribe to us for more content, join our Discord community as well. But we're going to be doing more of these free trading sessions where we teach you how to use the ghostquawk service, as well as a little bit more information on what risk on, risk off actually are, about volatility, about liquidity, all of these concepts that we touched on in this lecture today. We're going to be doing more follow-up videos to give you a little bit more information about that. So please stay tuned, subscribe to us, join our Discord community for more information. But other than that, have a great weekend. Happy trading.